into our Gear Up 2022, week 2 of getting ready for the audit season. We're grateful that you've taken the time to meet with us and to prepare for the upcoming audit. Just a quick reminder in terms of our goals for Gear Up. It's a short weekly meeting focusing on 1 to 2 tasks that you can get done to prepare for your upcoming year. It allows us to address common questions that we're asked as people start to think about audits, and provide a forum for clients to ask questions to work with us. We want this to be a short but beneficial point of contact where we can talk about things that are bothering you, things that you need to be prepared, and stuff like that. One quick point, it was asked about the spreadsheets and the recordings for last week. I hope to have the recording up. I am not literate in video recordings and stuff like that, so it's taken us a little bit longer to actually get it, but we will have the spreadsheets sent out to you. If you did not receive them, please open up email, send one to Ben. Make sure you touch base with him or with Candy to get the appropriate spreadsheets that you have. If you missed the session on the lease standard, which was week 1, we should have that up when you go to your portal. You should be able to see a link for the Gear Up sessions. As soon as we have that posted, that link will become live and you can watch last week's episode, as well as that's where you'll post to get a recording of this one. So we covered lease standards on the 7th. Today we're going to talk about composite score review, and then the rest of the schedule, as this is pointed out, will bounce from audit, compliance stuff to financial, but we're going to start with what we thought was probably a couple of the more pressing ones for people to get prepared for. So last week was lease standard. This week we're going to talk about our composite score. So just a reminder about what exactly a composite score. It's what the department uses to determine that a school has met has the financial capacity to operate within the Title IV program, or to receive and be the fiduciary for the federal student aid funds. It's comprised of 3 separate calculations. There's the primary reserve ratio, which is calculated by the adjusted equity divided by the total expenses. The equity ratio, which is modified equity and modified expenses. And then the net income ratio, which is your net income before taxes divided by the total revenue. Score ranges from -1 to 3.0. The department considers anything over 1.5 as passing, 1.0 to 1.4, you're in the zone, and 0.9 or below is considered a failed score. Failing or within being in the zone, scores will cause the school to put up a letter of credit, cash monitoring, provisional certification. So there are some potential consequences if you can't meet the financial requirements within the composite score. So that shouldn't be new to anybody unless you're new to the program and new to the system. But what we wanted to do is just kind of go over each of the calculations, help you understand where it's coming from, and that'll help you in terms of your planning as you're deciding in terms of distributions, purchases, and stuff like that. So the primary reserve ratio is the adjusted equity. It takes the adjusted equity and the total expenses. And adjusted equity is your equity less intangible assets, less unsecured related party receivables, less property, plant, and equipment, plus post-employment retirement liabilities, and plus debt obtained for long-term purposes, up to the amount of the associated fixed asset. And then there's a whole bunch of right of use asset post-implementation, the asset, the liability that we talked about last week that's created with the new lease standard. And then obviously total expenses is pretty clear. So that amount creates a percentage, and then the scores are weighted. So that percentage is then weighted and added to it. Now, each of your individual scores can only contribute or hurt up to a certain point. And this is a question I get asked a lot is, what's the max beneficial percentage, right? So what does this number needs to be? And for the primary reserve ratio, it's 15%. After that, if you have 18 or 20%, you're capped at the 3.0. And so there's no real benefit going beyond that other than just having a really healthy score or healthy balance sheet. Not that from a business standpoint, like, you definitely want to be stronger and stronger, but in terms of the composite score, there's no additional benefit beyond that 15%. All right, the second score is the equity ratio score. This takes your modified equity, which is different than your adjusted equity or your equity. So the department basically wants to take it and they're trying to boil down assets. So your modified equity is your equity less intangible assets, less unsecured related party receivables. And then your modified assets are your total assets, less those intangible assets and unsecured related party receivables. This is the same thing, creates a percentage, and the max beneficial percentage is 50%. So you can see with the first two scores, it's really about the equity or the assets of the company as it relates to the expenses, which is really your expenditures, as well as then your equity as it relates to your total assets. So it's trying to determine the financial strength from an equity or balance sheet standpoint. And it considers those two things. And again, each score caps out at -1 to 3 before they get weighted and then applied or combined together across all three. The last ratio is the income ratio. This is probably the easiest one for people to calculate because it's just your income before taxes divided by your total revenue. That creates a percentage, and the max beneficial percentage is 6%. So pretty straightforward, nothing in and out, simply taking the income before taxes, dividing it by the revenue gets you a percent. This is often referred to as your net income percent as well, or income before taxes. So it's a pretty easy number to get within QuickBooks or whatever financial system you're using. You can usually pull up an income statement, add the percentages to the side, and that you can just look down and really easily see it. Again, anything over 6% is no benefit to you. That doesn't mean it's not something you should shoot for and stuff like that. But in terms of it giving a benefit to the composite score, anything above that 6% is wasted effort. All right, so we wanted to focus today on some of the common issues that happen when calculating a composite score. And this isn't in terms of the actual calculation, but because you're relying on your books, these are the things that we find typically trip people up. Like we'll do a calculation, we'll think, oh, everything's okay. And then we run into an issue, and it's usually one of these items has occurred. And so these are the things that we want people to kind of focus on. The first one is that your retained earnings or your equity don't match your prior year audit. This is a pretty consistent one if you're not checking or familiar with closing the books, if you don't have a system that notifies you, hey, this entry that you're making is going to mess up your prior numbers, or if you fail to implement or record the adjusting entries and stuff like that. So the first thing that you want to do before we can really test or look at the composite score calculation to make sure we're right is that we've got to make sure retained earnings and equity match the prior year audit. This is also a step within the audit that we do when we receive your books. The first thing that we do is we look at it and we say, okay, do the books, do those earnings and equity, do they match the prior year audit report? Because that can at times make a significant adjustment. So step one is to make sure that we're starting with good beginning numbers. That's the retained earnings and equity. That means that we're looking at the current year as being it. The second is just making sure that your books are recorded on an accrual basis. This really, in many cases, boils down to accounts receivable and deferred tuition. So making sure that you're adjusting your books, that you're recording things on an accrual basis so that there's no wild swings and stuff like that. So pulling your reports, accounts receivable and deferred tuition should be calculated. Accounts receivables based on the charges less the money that you've received. And your deferred tuition should be on a straight line basis across the length of the program or the payment period, depending on how you're calculating or charging things. But it should be within a straight things. And most of your student management softwares actually help you with that calculation. The main thing is just making sure that you are recording those in and adjusting it. And that's from a best practice standpoint, that should be happening consistently throughout the year anyway, so that you know where you stand in terms of the audit and income and stuff like that. So making sure that your accrual accounts are adjusted to the correct balance. The next one is we call them equity drains. Okay. And typically when people start to struggle with the composite score, it's because they're struggling with those equity portions of the calculation. You have to have some positive numbers coming out of there. You can't just rely on just your income to meet the composite score. You need to have benefit coming from both of them. And when we talk about equity drains, probably the biggest thing is just taking out more money that's earned. So if there's less earnings coming in through the year, but you've consistently taken out a salary, it's very possible that you could still have the cash to meet that salary or that distribution. But instead of it actually being generated and covered by the income being generated by the business, you start to drain out that equity, and then you end up in a bad situation where equity is either not high enough or there's points where it could have gone into a negative situation and stuff like that. And then you run into all sorts of issues as it relates to the composite score and also the lease or the financial standards for accreditation and stuff like that. So making sure that the distributions from an ownership standpoint and stuff like that are not more than the income is key. Also, large loan increases and stuff like that. So if you've taken out a loan that's increased the cash balance, we saw this a lot with the COVID funds, with EIDL and stuff like that, where money's come in, and so you have a large cash balance, but then the cash gets distributed out. Now you have this large loan. Your equity is then dropped, way down comparatively to the loan and stuff like that. And you run into issues where you've drained out your equity. So being aware that like receiving loans and stuff like that, bringing the cash in, that it gets used for the purposes that it should be and stuff like that, and being aware that it needs to come back, and knowing that relationship between your equity and your loans. The other thing is just a secured related party receivables not being perfected, meaning that there's not a UCC filing with it. This is something that the department has kind of cracked down on quite a bit lately in terms of if the secured related party receivable is significant as it relates to the composite score, then they have been requesting to receive that documentation to show that it's not just a written agreement between the school and the owner, but it's also been filed and what's called perfected. And this just is a way for them to make sure that the related party is truly something that they could go after and collect or receive along those lines. So it's just strengthening that. In the past, 5-10 years ago, we could easily just get the agreement and put it in our work paper files and be fine, and have it be sufficient that there was that legal agreement between the school and the related party. But the department has really kind of pushed forward that they want to make sure that it's perfected, that there's a legal basis for them to come after. So those are our common issues when calculating the score. If you have any questions, go ahead and put them in the chat. If not, as those come up in our room, I'll just go ahead and just a review for next week. Next week's topic will be on the pre-audit documentation binder. And that's going to be led by Ben. He's going to talk about just the different things as you're preparing, gathering information and stuff like that, what that as what needs to go into those things. Our assignment for this week, what we challenge you to do in terms of your preparation, the first and foremost is just check your accounting records and either perform a composite score calculation or have us. You should have received, or if not, we've been trying to contact everybody. Just a general reminder that it's a lot of times what we like to do in November is just touch base and to have that look into yours to see where it's at. A lot of people are planning for Christmas bonuses or profit sharing and distributions and stuff like that as we get closer to the end of the year, and just making sure that that your records are adjusted and reconciled to the prior year audit balance, that you've made your accrual adjustments and stuff like that, so you're looking at good numbers, and then determining where you sit from a composite score standpoint will give you a better idea of what you need to do from now until the end of the year. Probably one of the biggest things about the composite score is that it is a point in time. So there's lots of things that we can do in November and December to strengthen that score. But January 1st, there's nothing that we can really do in terms of affecting the numbers. So, make sure that you are looking at it, make sure that you're aware of it. If you've had a prior year, like last year's was close to the 1.5, then we highly, highly recommend that you take a look at it. We want to make sure that you're adjusting things, or that you've got a good established estimate of where you're going to end for this year, so that there's not that surprise of, oh, we thought it was 1.5 or 1.6 and now it's a 1.2 or 1.3, and now you're in the zone and you got to either go on heightened cash monitoring or a letter of credit to shore it up and to operate the way that that you were wanting to. So if you were prior year, if you were really close, definitely perform that check. Even if you had a 3.0, if you've had significant changes within the way that things are done, if you've had significant distributions or a change in terms of the allocations, the assets and liabilities of the company, that also could throw you up. So just be aware and to make sure that you're looking at it, make sure that you're aware of it. And if you need help with, what can you do? What things could you look at? How can we, what decisions you're making between now and the end of the year that would affect it? Please don't hesitate to reach out and say, hey, here's what I've got. This is where I'm looking at, and I'm thinking about doing this. How's that going to affect my score? Much easier to have those conversations in November and December, where we can decide beforehand or advise or give counsel and say, look, this is what it should end up doing or affecting your score, than to have the conversation in January or February. And it's like, oh, you did this, and because of this, now your score, we're having issues and stuff like that. And we're trying to look at, what we could do to help from the score standpoint. Lastly, I just invite everybody, if you have people that that should be on these meetings, go ahead and invite them, even if they're not clients. We want this to be a useful and a series of meetings that are helpful in preparing for the audit, regardless of whether you're an LSA client or not. And with that, I don't see any other questions. So I just want to, again, thank you. I'm going to give you 10 extra minutes on this one that I stole from you on our first one in terms of getting set up. And we look forward to seeing you next week when we talk about pre-audit documentation binders.